macro and discuss later on. As I said before, it's going to be the basis for our macro watch. So thank you for your patience to wait. I start to read Andreas' face. I know what he's doing.
So, too many windows.
Okay.
So, okay. Basically, I recycled the CFA presentation of last week and I updated it. And as we had technical problem, I even included the latest IMF outlook. So at the moment, everybody is a COVID-19 expert, or at least has to talk about it. So I will do that as well. I will handle or try to give you a certain opinion about global and US GDP, what happened in the market within 2 weeks from almost all-time high, which were in February, to a bear market, which is the fastest on record. I will tell you about monetary stimulus, fiscal stimulus, helicopter money, and additional what I learned yesterday after the closing bell, what this probably will mean. Which is probably controversial. Last but not least, I will conclude with the impact on what we should do or what we can do. This has not really changed, and if there are questions, I did update some supporting charts. The key point at the moment is obviously this. Different countries, different way to handle it. I mean, China, we are not sure about the figures, but at least for Japan and South Korea, we can say these are Western democracy plus minus. And if you see the number of cases and in particular deaths per 1 million of population, it is almost close to 0. So 1 and 4. In China, it's 2, but there I would make a question mark. They test, they control, it seems to work. We have Austria. Maybe you have seen the latest news yesterday. They are starting to unwind the lockdown partially, but they were extremely fast in stopping all and putting the whole Tyrol into quarantine because they had there a huge outbreak. Also, that severe measurement seems to work. Israel, I've seen a documentary about Israel. They handle this pretty well, but I'm not so sure if we would like to have that in the Western world. Basically, everybody's tracked on the mobile, everybody gets controlled, and if you get by accidents, for instance, close to somebody who has an illness or was tested positive, you must immediately go to 2 weeks quarantine. There was an example where somebody has a garden and next to the garden was a little paved way and somebody passed there and this person is now 2 weeks in quarantine, although has no signs and probably never had contact. If you don't do that, the Secret Service or the police will pick you up and put you either at home or to other places. The shocking bit is obviously Spain, Italy, and France. France, the latest thing is they have prolonged it for a month like Italy, but Mr. Macron had even to admit we don't have it under control, our healthcare system is collapsing. Spain has started to let partially people go back to work, but you can see from the number of new deaths, which is 2 days ago, or the number of deaths per 1 million population, it's extremely high. These 3 countries definitely have a problem. Catching up is the UK. The UK and the US did a similar thing, i.e. they ignored it, like China. The UK even said we do a herd immunization. In the end, they changed. What you can see is that unfortunately they are catching up with Spain and Italy. The healthcare system there is as well at the edge to collapse. And last but not least, if you look in total amount of people, given the amount of people in America, you can still argue deaths per 1 million population is okayish, but it is still not really under control besides the New York City. So there are different strategies. What we can definitely say is if you have at least a 3 to 4 weeks lockdown, figures come down. The key question will be what happens next when you reopen, and there severe measures will be put in place. If not, you will have a second and a third wave. China, I don't know if this figure is from BlackRock or not, but basically what it shows you is that the usage of the traffic is above the use with 1 year ago. So they are more than back to normal, at least in terms of traffic and in terms of production as well. In terms of service sector, we can still argue, but there was a fast recovery from the lockdown. You have probably seen forecasts. The latest one from the US was we will see 35% down in Q2. What you have to know is this is the American way or the Anglo-Saxon way. They take a quarter figure and analyze that. All shown investment banks basically expect a V-shaped recovery. So if you have, like Mr. Yellen said recently, roughly 30%, or if you say 35%, what you definitely need isn't that you see on the right-hand side in Q3, Q4, you must have quarter over quarter growth rate above 15 or around 15% in Q4. The IMF has updated its global economic outlook, and I wouldn't give too much on the height of the figure, but what is clear, there is for sure a global recession in 2020, and there is a strong recovery in 2021. If it's minus 3%, 2 months ago we were at 3.2% plus. Question mark, because nobody really can know that, and it all depends how fast this lockdown will stop and how fast you unwind all the measures. But what's for sure, you will have a recession. These figures were published, and you have probably seen equities and bonds rose after the announcement, like nothing has happened. The reason for that is obviously the latest announcement of the Fed, but let's start from scratch. Basically, you see monetary stimulus across the globe here shown in 5 examples. There's only one real key message. At the beginning, the Federal Reserve Bank has learned from 2008, we need to have swap lines with most major central banks in the world, that the dollar as a reserve currency and the market itself for bonds and US repo markets keep functioning, and that they have achieved with the first measurement. You saw then across the globe fiscal stimulus here shown for the European Union. The main problem for the European Union was, and to a certain extent still is, you see here the 4 big one, fiscal stimulus plus loan guarantee programs, but completely uncoordinated, lack of leadership, and there is no willingness really to act as a European Union. And the solution could be the ISM loans, the European Saving Mechanism, but this would come with restructuring measures and severe saving programs for the countries. That's why there was the discussion about the Corona bonds. The similar, you see here, global fiscal stimulus, the amounts are big. What's remarkable is that we have helicopter money, or a kind of, because helicopter money in theory is directly from central banks. In most cases here it comes from the government or from a budget of the city of Hong Kong as an example. In Macau you got vouchers, but the important part is not only companies need liquidity to survive, also people who lose their job, and in the US and in Japan is where the latest two, they have implemented that. What it all means for the Fed is they found out, or they believed that this was not enough, so they implemented a new program. The new program last week has 3 aspects. One is that they can buy everything which was before the 22nd of March investment grade, and this might be now double B, like for instance Ford. They treat it as investment grade, and they buy corporate bonds. So not only they buy corporate investment grade bonds, but also fallen angels. They on top of it decided to buy ETFs on high yield. So basically all US dollar denominated bonds with a certain size are in that such ETF. So they indirectly help such companies. And last but not least, with the help of the finance department and with the help of BlackRock, they as well provide direct credits, not loan, direct credits to such corporates. You see here, the European Union, you remember, there was no Corona bonds, there was the discussion how to solve it. They came up with a solution just before Easter. On one hand, they have decided that we will have 640 billion euros, and there are three pillars of it. One is the saving mechanism, but without the strong conditions normally attached to it. So Italy and Spain and maybe others, they just can get cheap credits without even thinking of how to repay that in future and how to consolidate the state budget. There is direct liquidity support for smaller businesses, and there is something which, at least in Switzerland and in Germany, is known as help for the employers to pay the employees. So they have a support wage subsidized. I came across a presentation which basically was checking the spreads and also to a certain extent how equities reacted. The shortcut to all that is you see that spreads have come down. You see it here, global high yield markets. We are off the high. This is mainly driven by central bank buying and only partially by recovery. The point I would like to stress here is that this liquidity injection is so big that most likely we will get all a big surprise, which I will come in the equity part, what I concretely mean.
Quick question, Andreas. Can I ask you something in the context of the rebuy program of corporate and corporate bonds in the US? Exactly. The government made a decision that they will buy back certain corporate bonds. In the beginning, I remember there was only discussions about investment grade bonds. Now it seems that high yield bonds and even junk bonds are also part of this buyback program. Is there any mechanism or is there any list how an investor can understand that his bonds will be money floated in? Because a lot of people buy single bonds, not ETFs. So it's clear that ETFs have also partly high yield and emerging market debt in them, and it's an indirect buy of these bonds. But are there also direct purchases of corporate bonds in high yield segments? And how can an investor figure out whether his bond is part of this program? Is there any option?
Yes, I mean, according to what is public, it's even here in yellow, all the bonds which were at the 22nd of March investment grade and will be downgraded, because if you look at the chart, you see that 42% of all investment grade bonds are now BBB. This is a problem known already for years, and everybody was afraid if we get a recession, we will see that these BBB bonds get BB, i.e. junk, and then institutional investors have to sell it. The Fed obviously knows that, and in order to twist the system, they decided that everything which was until the 22nd investment grade, and it might be now BB or even lower, they can buy and they treat it as investment grade. And obviously, I don't know if you can do a search mechanism, but basically bond by bond, you can double check. Ford is a good example, or Pemex is a good example. They are both now, at least from some rating agency, in the BB area, and they can be directly bought. For the junk bond or high yield market, they didn't go that far. But basically what they said, or what I read, is that they are allowed to buy all US listed ETFs, and most of the bonds I'm aware of are in that, but this is only indirectly. So things which were a junk before are at the moment not directly eligible, but things which become chunks since the 22nd of March, and that might be a lot depending on how much time this crisis will be lasting, they can buy it, and somehow they buy it from institutional investors, which will be forced by regulation to sell it.
Thank you. Thank you, Andreas.
Okay. On the equity side, what you can see here, for instance, the MSCI Russia was in January on a several-year high. The S&P, the white line, was even on an all-time high. In March, within 2 weeks, most markets dropped more than 20%. So you really went from a bull market, which lasted 12 years, within 2 weeks to a bear market. When I first did this chart, obviously we were more down at -30, -20%. I updated it yesterday, and you can see at least up to now, there is a kind of V-shaped recovery. And today, for instance, I came across a research, and the guy wrote, this is an unjustified rally because fundamentals are bad, earnings outlook is bad, and therefore we should be lower. I would agree if fundamentals were to be the guide at the moment. Goldman Sachs made yesterday a statement, and some other investment banks jumped in, and I would agree with that. The actual level of the S&P is either 25% too high, or the outlook for earnings for next year must be 25% higher. Both is not the case. Now the question is, why are we where we are? And the answer is the latest Fed program is so big that it's not just QE unlimited. It's what we have talked before. And now you can have various opinions. I'm in the camp who believes that we have seen the lows, similar to what you see here. So I believe that we have seen the lows, and most of these investment banks quoted here, they claim that we have a kind of floor due to the Fed intervention. And if that is true, you can think it further. We have a market which always discounts the future, and the future based on GDP, obviously we are talking of EPS, but look at this, 2021, GDP is expected to grow significantly. Okay, now I lost it. Even the IMF, which is very conservative and behind the curve, expects a similar thing. And normally, when you have such GDP growth, this translates into EPS, and EPS is the main driver for stock market prices. Therefore, and I would agree with that, the next year we're going to see levels which are at all-time highs, and the rally will go on. We will see a melt up, and we won't see a testing of the lows. And therefore, the opinion of these guys and my guy is it is very tricky to buy the Fed, to fight the Fed. You have indicators which, for instance, show you how is the market feeling at the moment. Here is the greed and fear indicator. 2 weeks ago, we were at 0, extreme fear. Extreme fear normally is a buying indicator. We have seen a rally. You see, we are almost neutral. But we are definitely not in greed. Today came out, or yesterday actually, came out the Merrill Lynch Bank of America Money Manager report. Cash levels are at high levels. At high levels means that this is normally a good buying signal. We have had as well the capitulation in the retail sector. There are some technical twists here, but the point is within 2 weeks, the drop was extremely, and it was almost as high as in 2007 to 2009, but there it took a year. Here it took just 2 weeks. So you have also capitulation on the retail side. Therefore, there is more ammunition that maybe down the road, this liquidity squeeze in combination with the fiscal stimulus will play out. We have at the moment earnings season. Yesterday, banks came out and the figures were bad. There will be more around, the figures will be bad. But actually the FactSet forward-looking EPS monitor is at such low levels that probably this is gonna met. Not to be outperformed, but it's gonna be met. So, and people actually don't care. They price in the future. Nobody can really know the future, but the future is probably much better than this 35% negative GDP growth in Q2. For the CFA presentation, I had the pros and cons of buy the dips and sell the rally. In the meantime, this is a bit outdated because of the latest Fed intervention. What I would still highlight here is the second bold part, Goldman Sachs Wealth Management. They do basically a scaling in and scaling out. Normally they do that in the junk bond market. This time they have decided that they play the US market and not the high yield market. And if you would have done this, this was published more than 2 weeks ago. The S&P is up more than 20% since this was published. Wouldn't be a bad strategy. They will continue scaling in, and it is open if they believe the story I told you about the Fed and its impact and the melt up. But what is definitely the case, they will keep on adding risk over time. A word of warning, we had the Spanish flu 100 years ago, roughly. It is really key for outlook of GDP and of equity market that the second wave will be muted, and the third and the fourth wave, which if there is no vaccine, must be expected, will be contained as well. If not, the move downwards came 100 years ago only when the second wave started, the big move. This at the moment is not expected. Austria clearly stated yesterday, if the figures get worse, if we see more cases, we have an escape plan and we will immediately go back to the full lockdown. So with that, we are basically back to the conclusion, which are very similar to what has been said last time. So it is definitely time to restructure portfolios. It is definitely time to reallocate on the equity side. There, knowing that the US is one of the most expensive market, but knowing as well the stimulus program, don't fight the Fed, buy US exposure. All these measures have an impact on dollar. Dollar is expected to weaken, here shown as the DXY index. It has already weakened slightly, but it's expected to weaken further. If that happens, that will help emerging markets. It is expected that we will see a certain amount of inflation. When I did the presentation here for the CFA, you see the gold chart. I draw that line, and the title was, we might break out of the triangle, that sell-off or the consolidation is over, and 1 week later you see where we are. We can argue that it went too fast, too far, but I would definitely argue that being not a fan of gold at the moment, gold might be helpful in a portfolio context. Definitely what we already started to do is you can buy fallen angels, be it Pemex as an example of now junk bond, or Ford, or be it already junk bonds, which you believe that the balance sheet is strong enough to survive. That might make sense. Volatility, when this was first written, was at 80. Now we are roughly at 39, 40 in the S&P, but still volatility is elevated. It probably should come down. There is definitely no value case. So you have to believe that this massive, never seen before stimulus from the Fed, never seen global fiscal stimulus, never seen stimulus from the ECB, continuing stimulus in Japan, and will somehow move asset prices over the next 12 months up. For the American side, I'm pretty sure. For the European, I make a big question mark. You see here European EPS. I said this in the last 10 years several times. US is cheap, Europe is cheap for a reason, and the reason is lack of growth. Here you see Morgan Stanley and Goldman Sachs and others aggregated estimated EPS over the next 3 years. Well, if they are right, big question mark. It will take a while until we see levels of before. Sorry, 1 second. Therefore, I would argue that Europe will stay cheap for the forward-looking time. And knowing that a lot of Swiss-based asset managers have here a different opinion, but over the last 10 years, they were wrong. We will see what the future will bring, but the point is, don't fight the Fed. What they did now, I could never dream of. I always said there is a put. There was the Bernanke put. Now is the Powell put, but this put has reached a level which is, for me at least, unimaginable how big that amount of money which is going to be put into the market. I heard yesterday a figure that almost 20% of US GDP is dedicated to stimulus. And this is huge for 3-4 months. So with that, I'm basically through the main points.
Andreas, thank you very much for presentation. Maybe somebody has to add something to Andreas. I have a couple of questions, which I think are also interesting for investors. One question I have is regarding bonds and the current yields we see, and also the movement of the market, which we can observe right now. So what I realized is that the new issues of corporate debt, we see a higher coupon. So we see new issues where we have investment rating or even A rating with durations, regular durations of 5 to 10 years, with coupon at 4 or 5, even 6%, which was impossible a couple of months ago. So my question is, why do we see that? Is that on the one hand the fact that companies realize that investors are feared and they're not ready to buy anything, so they need to attract them with a higher yields, or is that the view from these companies or the expectancy of the investors that in the future we will see some inflation, the US dollar, weakening of the US dollar? Can you interpret this situation, and maybe just comment on the potential inflation of the US currency?
Well, there are 3 points in one. Huh? Well, on one hand, the spreads on investment grade bonds have widened dramatically. I skipped the chart, but they have at least 150 to 200 pips widen, which you see in a higher coupon. Don't ask me how big the inflation will be in the US, but definitely this will create inflation. And actually it is one of the, let's say, goals which are not officially communicated by the Fed to weaken the dollar, measured by the DXY index, so a weighted average of various currencies. And then last but not least, if you have a recession and you are a corporate bond issuer, you have to attract investor. So not only you have a higher spread, but you probably try to offer an interesting coupon. but at the same time, I mean, yesterday, you remember we had the Santander Mexico, a very attractive coupon, and today the first noted price was 101. So there is demand, and the game continues like before, but we are on a level which is at least 2% higher than 4 weeks ago.
Okay, but there additional question in this context. So talking about inflation, well, that would be logical from the mathematical or the classical view on economics that if you print money, there must be inflation. But what we did see 2008, everybody was expecting after the QE programs that the inflation will explode. And all mathematical models, there are different ones which basically explain the inflation, the relation of inflation towards unemployment, towards money, and so on in the system. They didn't work, and I talked also to different academics, and they couldn't explain why the inflation did not happen in that amount which we'll expect. Isn't that the same situation now? Possible that the money will be stuck in the banks, and basically we won't see such a high inflation as we might think because of the QE program?
I mean, on one hand, at that time, banks were printing money, but at the same time have a sterilization program. And the amount today is, I don't know which factor, but probably 10 times or even more larger than at that time. And nobody talked of neutralization of this kind of money printing. And some, if you give credit as a Fed, you cannot really neutralize. But at the same time, the goal of the QE is to a certain extent to push yields lower. And in theory, it shouldn't work. In reality, it seems it works. At least that's what academic guys tell us. I believe it has a certain dampened effect. If it has it in the future, I make a question mark, because these announced figures, if I'm not completely wrong, there was more than 2 trillion in taxes, and there was 2.2 trillion in the latest Fed program, and there was much more before. Also, the ECB is now, or has reached levels which we have never seen before. I mean, the latest fiscal program, only fiscal, is 640 or 30 billion. The latest announcement of Mrs. Lagarde was basically similar to the Fed. We do an unlimited amount and of QE of an unlimited time. How and where this inflation will show up, we can make a question mark. I'm not smarter than these guys you ask for. But one possible area is in real assets. So I'm back to what I told you before. Maybe next year, the US equity market will have an all-time high again. Probably gold is not much away from the all-time high. Gold might as well go higher than we have seen before. I've had, let's call it a gold expert in the office, and they believe that for the gold market, this is the third wave. This is what they call end game. Obviously, gold bulls are bears for the rest, and the central banks will blow it up. This is all completely open, but the fact is that it's unimaginable how big these figures are. This morning, Paul Donovan, that's the chief economist of UBS, said we had the IMF with some helpful statistic, and we had some surveys. However, nobody can know, and all the data which is somehow with facts underlined are aged, so useless, and all the survey data are by definition distorted by the actual fact, and people who fill in the survey at the moment can only be very special, because if you are, for instance, a purchase manager, you have other problems than filling this PMA data survey. And he honestly, and I think he's a very smart guy, although he's the guy who had this problem with the pigs and the Chinese, if you remember, he basically said, nobody knows and nobody cares. And the investment banks on Wall Street go further. they say the only thing which matters is the amount of QE, and this amount is so huge that we will see an asset inflation. They call it rather a melt up, but last time actually you say we haven't seen inflation. But I would argue that part of it was in asset prices. Also look at art, look at old-timer. It's not really what I'm invested in, but this stuff have exploded.
Okay, thank you very much, Andreas. I have from my side a last question. It's regarding the currency. Since it's a very important question for the investors, not only which asset class to choose and which country to choose, but also the currency risks are there. And I remember you told that you see that weakening of US dollar will happen, and that will be good for emerging markets. Could you comment a bit more in detail? So how you see the FX US dollar to euro, the main currency? I think we don't have to discuss British pound or Swiss francs. We can, of course, but especially US dollar and euro, these are the main questions I get confronted from the client side. What is the expectancy? Yeah.
One second.
Sure.
Okay. Do you see my Bloomberg screen?
Yes.
This is the euro dollar. So it is the tricky one. The easiest one is the weighted the DXY index, which I mentioned before. This is the way you can avoid an answer, although you give an answer, because this one is supposed to weaken, but nobody really, unless you speculate in it, and you can actually, there are futures on it, nobody really thinks in this one. And I'm no currency expert. Normally I try not to answer such questions because short term you can play with charts, mid-term it is tricky. If really the dollar depreciates, it could be that you have an appreciation pressure in the euro, but at the same time, if you look at the economic outlook of Eurozone against US, it is hard to find fundamental factors why the European currency should strengthen. Therefore, my answer, which is no answer, I would bet on a range bound, which is no answer. I know, but I really have no clue. And the pound, I would argue until we have more clarity about the Brexit, not Brexit, because don't forget, they are still not out officially. They should now negotiate the contract, how to go out by the end of the year. Nobody really expects an agreement, and you see that, I mean, 135 to 115 within 3 months. It's all set. But on average, it should really weaken against the euro, against the Swissy, and probably, but question mark, probably also against the dollar.
Thank you again. Anybody else who has a questions towards Andreas and is very welcome to ask. Or okay, it seems that for the rest everything is clear. Andreas, thank you very much for your view. Yeah, we're looking forward to receive the Market Watch. with with the synopsis of today's talk and with your recommendations and market overview. And if there are no more questions, we would finish our meeting.
One thing that is very interesting, Andreas, besides that the Fed has stepped in with lots of liquidity, it seems that most investors, first of all, institutional investors, haven't really much participated in the most recent rally. So how do you expect this to evolve in the near future? Do you think that's going to be a lot of buying caused by investors who are afraid to miss the opportunity? Or do you expect the larger investors to step aside and wait for some more like clarity in the development of the COVID-19 development?
I hope you can still see me. I tried to pull up a chart, but it seems talking and pulling up a chart at the same time is not working the way I would like to it. So, I mean, the latest figure of the asset manager report confirms what you just said. Institutional investors have not participated, have not stepped in. By the contrary, they have built up cash. If history is any guide, I would argue that this rally will go unparticipated mostly by institutional investor, because if you do an investment process and you use some facts, some fundamental data, it is hard or even impossible to come up with a positive opinion. Only if you believe and if you have maybe seen what happened in 2008 and maybe you were also part in the year 2000 to 2001, actually 2003. These three crises to be compared. First, the stimulus is much bigger, and second, in the last two occasions, also the recovery went mostly uninvested. I remember perfectly 2009 in summer, all the indicators were bullish, but nobody wanted to buy equities, nobody. And everybody was uninvested. And it went on, and we had 2-3 hiccups, and every time there was a hiccup, people continued saying, well, now finally we have the clearance of the market, which didn't happen. And I would bet, and it's really a bet, nobody can know, but institutional investor, pension funds, etc., they will wait with deploying the cash position, especially fully to risk. But the future will show.
Thank you. Yeah, that would also be my opinion.
Maybe one more question from the side. You made the point that we shouldn't bet against the Fed, so US will drive the rebound and the growth. Maybe there, when we take a look at industries, it was very interesting so far that the traditionally defensive industries, they actually suffered more. And now also the rebound was then mainly driven by high beta titles, especially tech titles. I mean, it also lays like in the nature of this crisis that we see now with the virus and the lockdowns. But would you expect that this continues like that we see the strongest growth in tech and that also the other industries are partly not that able to recover very well?
Ooh. Well, the short answer is probably yes, and a bit more pronounced answer is, however, it depends. For instance, the tech sector in the US, only tech, didn't have a bear market. It went down 18% and recovered sharply. Biotech, healthcare, digital health had a huge recovery. Everything which is things like Amazon or Netflix or Disney, most of them, probably not all, one would have to check case by case, but they are profiting from this crisis. Value stocks, on the other hand, I mean, I have 3 or 4 value managers which regularly knock on our door, and they keep telling me since 12 years, value will outperform growth, which is to be expected over nowadays I would say a very long period of time, because value matters, but at the moment it doesn't. So yes, I believe that momentum will outperform. A bit more selective maybe like before, but on average, yes. Also on Monday, I mean, we had a 2%, let's call it mini consolidation, but the Nasdaq actually was the whole time positive and closed up, if I'm not mistaken, 1%. Yesterday was up 4%. It's absolute insane. Valuation matters in theory, but at the moment it's all swamped by money.
What is also interesting is looking at small caps in the US in form of, for example, the Russell 2000 index. There you see a very strong drawdown compared to the major indices. And what would also be an interesting point is to think about how this will develop in the near future, because as all these measures might arrive in the markets, we might see a big rebound in the small caps as well. Maybe it takes a little bit more time, but this will also be an interesting opportunity, in my opinion.
Yeah, I mean, I think 2 days ago, I read an analysis that 30% of the Russell 2000 companies are loss-making. These are best candidates for this credit program of the Fed. They might indirectly profit from the high yield purchase, but they might profit. So these zombie companies might continue to live. And if the economic outlook for 2021 materializes, with a delay, you will see a huge rebound of the small cap. Fully agree. But they have underperformed probably for the last 18 to 24 months. One would have to check. But definitely, you find there interesting companies. And I wouldn't buy just the Russell 2000, because then you get also this 30% of the zombies, but or the rest will have a significant rebound.
Mm-hmm.
I need to rush out, but thank you very much, Andreas. It was very interesting, and thank you very much for the possibility to join. Have a good afternoon.
Thanks.
Thank you. Thank you very much from our side as well. Yeah, it was a great discussion. Looking forward to see you all in 2 weeks again. And thank you, Andreas, for your overview, market insight.
You're welcome.
Thank you, Andreas.
Have a good day.
Have a good day.
Bye. Bye-bye.
Thank you. Bye.